Hello, welcome back to another episode of Carta Insights Live. My name is Peter Walker. I'm the head of insights at Carta. As you can see, for the first time on Carta Insights Live, I am no longer alone on this live stream. My good friend Mendel Chuang, thank you so much for joining me. We're going to dig into all things pre-seed investing now with Mendel. But I wanted to set the stage a little bit with a bit of data that we put out recently. So bear with me here. Wanted to take a look at pre-seed investing over the last, call it three and a half years. So, in 2021 and 2022, there was a boom in pre-seed. It was a kind of a wild time. Lots of new angel investors getting started in the business, lots of new institutional investors going earlier in the process. So really high invested capital amounts. That's the top bars there in black. And then also quite a few companies raising per quarter. And then you can see some decline through the latter half of 2022 and a little bit of a bump up so far in Q2 of 2023, at least in invested capital. So while it may seem like we're kind of well off the highs here, it is important to note that pre-seed as a stage is doing a lot better than, any of the later stage parts of venture. So that is something to be grateful for. On Carta, a ton of pre-seed investment comes through safes as opposed to convertible notes. And within those safes, about 96% of them, so virtually all of them, have a valuation cap. So we'll get into a little bit about valuation caps and how you kind of think through those in a bit. But just know that that is the most common term within a safe investment. And the median valuation caps for those safes are sort of dictated a little bit by how much you're going to raise in a round. So the median across Carta in general was 10 million in Q2, but you can see that that actually declines to 5.5 million if you're looking to raise, less than 250K. So it is very highly sensitive to the amount that you're going to raise. We've got some stuff on seed valuations and Series A valuations. We can talk about kind of the distinctions between there, but would love to, Mendel, just kind of get your general impressions right now. How are you feeling about pre-seed at the moment?
So I say pre-seed has actually held up. I think, one of the interesting things is that there are still happening. And I actually think it's one of the most exciting sectors when it comes to startups. Because this is all the new stuff that's starting. This is kind of the first stage. It's friends and family kind of pre-seed fall into almost a very similar bucket where new startups are starting out. And it's probably the most exciting time for any startup where anything is possible. And you're just starting to discover if your idea, the market you're targeting, if your audience wants what you're trying to sell them. And so yeah. I think it's the most exciting time for a lot of founders, and it's great for investors to be looking at this.
Yeah, I couldn't agree more. I think it's, there's a ton of hope at the early parts of these company life cycles. But maybe before we get into what's going on in, pre-seed investing, you and I were talking a little bit beforehand about the difference between bootstrapping or raising, from VCs or from other people. How do you talk to founders about whether or not they should think about bootstrapping?
So I think when it comes to fundraising, a lot of times founders kind of get into this idea that like, oh, I have to go raise from angels, I have to raise from VCs. Just because I'm doing a startup, that sounds like what everyone else is doing. And so that's what I should do. And I think it's important for founders to realize that raising external funding means you're taking your startup down kind of a very specific path. Once you take external funding, definitely from VCs, but even from angels, there's an expectation that your company is going to grow bigger and bigger, and you're going to raise another round at a higher valuation. And then hopefully, the great vision is to do an IPO. And so there's all of these expectations. And with each round, with money you raise, you're giving up some control of your company. You're giving up, most people are thinking about the economics, but you're also giving up control. And so what's interesting is if you raise even angel, you start kind of this idea of there's going to be a later round. So you're signing up for kind of having to scale and having to grow. And so what's interesting, as I talk to some founders, is for some founders, this is fine. This is what you want to do. You want to become a big global company. You're going to want to become public one of these days. That's the path you're going down. And if that's the case, you're aligned. It works well with angels and VCs. But if you kind of say, hey, I have this small group, I want to do something very nice for them. If I made $1 million a year from this or 10 million a year from this, I'm going to be happy. And that's kind of the market I want to play in. Angels and VCs probably aren't right for you because there's going to be a conflict. I mean, you might say, all right, I only want to serve this demographic. But when you raise angels and VCs, they're going to be like, well, okay, your product can also serve this other tangential thing. In order for you to grow, you need to expand your market. You need to either, go and target these other groups as well, which changes your product, it changes your focus. And if you as a founder, that's not what you want to do, you become misaligned with other people who own part of your company. And so, my experience with this is I've talked to several founders over the years, and there's some that, in their first startup, they raised VC funding and they didn't quite understand why it was happening, where they were very happy with the segment of the population that they were serving, the product that they had built for them. But their investors constantly asked them to expand more or charge more to these users, or add these additional features so you can upsell them. So a lot of these requests that just didn't align with what they wanted. And they would get into the conflicts over that. And then with their second startup, they come in and just say, all right, I know what that route is. That's not for me. I'm going to bootstrap this. I'm going to just get revenue from my customers to help pay for this. And that for them, the second time around, decided just not to touch the angel VC money because it would set them in a path that they didn't want to go. And I've seen that, and these second time founders are well aware because they've done it once before and it wasn't the right thing for them. And so when they come around, it's like, I think it's just a smarter way to go.
Totally. I think if you don't, VC is almost, it's an important route. I'm glad it exists in terms of the ways that we build new companies in the US in particular, but it is almost like a last resort. If you can build a wonderful business that is going to be, profitable and you can reinvest that revenue into growing the business further, that's the best place to be. You control more of your business. You don't have to deal with outside investors who may have different timelines for you in terms of growth and other things. So that's definitely probably should be the first way you think about building a business. And I'm glad that that sort of is getting back a little bit into the ecosystem after perhaps, everybody wanting to raise VC cash in 2021 and last year. By the way, if you want to ask Mendel or I a question, throw it in the comments on LinkedIn and we can kind of show it on screen here. When we get to this discussion of bootstrapping or raising VC, something you said was pretty interesting there. So you consider angels, on a safe. Those are VC investors. Those are not VC investors. Like, how do you think about those people?
So there are some angels who will put money in, kind of hoping for the best, not going to have too much in terms of expectations where you go. But even the whole idea of an angel is that they're putting money in so that you're going to raise a future round, because they want a financial return. That's why they're giving you money for the most part. Now, some angels have other reasons that are a higher priority for them, where it's, more about kind of maintaining the friendship with you or just seeing how this goes or just supporting you on your journey. But
those
for
are some
angels,
good friends,
yeah, exactly.
Right. Gotta get some more of those friends for me. Yeah, that's nice.
And so, but for angels, the whole reason they invest on a safe is that it's going to eventually convert into equity because you raise another round and hopefully at a higher valuation. So you're investing in something. And so even for angels, that the whole reason the ecosystem works is that you're going to get bigger and bigger, raise at a higher valuation, and then hopefully eventually an IPO.
Yeah. I think it's important that people just understand that a safe, just based on the way that the instrument is structured, depends upon a future priced equity round in order for that conversion to happen to those people. So if you raise from friends and family and you don't actually need any more money beyond that initial raise, those friends and family might be out of the loop because it never converts into priced equity, even if the business is doing well. So you just got to be careful that you're doing right by those people. And it may be that the safe isn't the perfect instrument for you if you're only going to say, hey, I need $100,000 to get this business off the ground, and I'm never going to need any future funding, then maybe a safe isn't the way to go.
Yeah. And I think with even just safes and how they came about, I think it's important for founders to understand that the most traditional way in which a company raises funding is a price round. And like if a price round worked at all different stages, particularly the early stages, that would probably be the preferred method for everyone. In essence, you own actual stock in the company. But the problem with the price round is you've got to have lawyers involved, And there's a lot of negotiations. This is, when I was saying earlier, when you fundraise, it's about control and economics. And the control piece is particularly fleshed out in a price round. Like, do the investors get a board seat? Are there, additional rights and they veto certain things? A lot of these things come out in a price round and are negotiated. But because they're negotiated, there's a lot more discussion that has to happen, and the fees go up quite a bit. And so that's why at the early stage, when you're raising, a few $100,000, it doesn't make sense to spend $100,000 on lawyers and fees to get that round closed. And then the next move to there was the convertible notes, that was one step further. Said, okay, let's focus more on just the economics of it. So it still had like liquidity preferences and paybacks and things like that that could work into the convertible note. And that helped in terms of saying, okay, we don't need to spend the $100,000 to do all the back and forth negotiation, but we still have a round and have to negotiate some parts, but it costs less, but you still had to involve a lawyer. And then the last part is the SAFE came along and said, hey, let's get the lawyer out of this. Let's just make it a standard doc and take money in as quickly as possible. So understanding that evolution is really important for a founder to say, yeah, even if you take a SAFE, you've kind of just delayed a lot of these discussions that would have happened in the past, but they should still happen at some point.
Yeah, I think it's a great reminder to everyone that these instruments cropped up for very specific reasons, and they get less and less intensive in terms of the lawyer time and the actual details of the instrument as you go down the stack. But that leaves those conversations for later. You're not really getting them out of the way in an easier way. You're just avoiding them, which is the point of giving the money on a SAFE in these early stage companies, because deciding on the exact valuation of a company that's 4 months old is really hard. It's almost impossible to know what is this company actually worth right now. So getting into a little bit more about valuations and specifics, you were really interested, and I thought had some great points. So when we look at these valuation caps, so on Carta, again, the median was 10 million in Q2, but if you're raising, a little bit less, if you're raising 500K or so, it's 6.5 million. But then the priced seed rounds were going off at a pre-money valuation of 13 million. So does that make sense to you, the gap between those two things? Or how do you think about SAFEs to seed?
Yeah, so I think the way the market has happened over the last few years is kind of it's not ordinary that it happens this way. And so what's happened is the later stages have kind of decreased in terms of the valuation caps. And that's kind of slowly rippled into the earlier and earlier stages. That said, it looks like pre-seed has stayed relatively insulated from that downturn. And as you can look, across the data here, it hasn't dropped too much over the last 2 years. And so what's happened now, though, is that for most investors, they're looking for usually a 2 to 3x increase from one round to another. That's where the economics start making sense for them, because not all their investments are going to be able to make it to the next round. And we're starting to see this kind of happen for kind of the later stages where you can still get a 2 to 3x increase. But right now is a very odd time for kind of pre-seed, where because the initial valuations have not decreased, you're going from, in some of these cases, you're raising at a 10 million valuation, and then at the pre-seed, and then you go to the seed and it's at a 13. That's definitely not a 2 to 3x. And so it's one of these things that I think unless the numbers start changing, both investors and founders need to be aware that the markup from kind of the pre-seed to the seed may not be as high as they were expecting in the past. Whereas the seed to the A, there may be more of a markup when it hits there. Right. So in this case, the A is at kind of 39, almost 40 million. And so there you're seeing the much more of the typical markup. So it's something to be aware of. I don't know I don't have a crystal ball. I can't predict what will happen in the future. But right now, if the numbers stay exactly where they are, you don't see the typical markup. And I think for some founders, that's harder for them, maybe harder for them to digest. And I definitely know for investors, it doesn't make it it's definitely harder for them, because not all of their investments are going to be able to continue. So it's something to be aware of as you raise as a founder.
Do you think that that's do you think that some of this comes down to the entrance of a lot of new people into angel and pre-seed investing over the last couple of years? Because it sounds like if you're a VC, and you've been in this business for a little while, you definitely have expectations about the gap between a valuation cap and then an eventual price equity valuation. And you want it to be, as you said, 2 to 3x makes a lot of sense. But if you're just someone who's angel investing for the first time and, you invest at a valuation cap of 10 million, and then you get a price round at 13, you might think, hey, that's already up. Like, how great,
Yeah, I mean, I definitely the influx of money over the last few years has affected this, and I think has increased certain valuations. I don't know. I mean, there's some thought. It's like, okay, well, there's a lot of exciting things happening now. So 1 to 2 years out from now, when they go from raising their pre-seed to raising their seed, that the market will be better again. And so
Right.
in the past, raising at a 20, 30 million valuation for a seed was reasonable. And so you could easily see the 2 to 3x off of the 10 had, a year or two ago. So there's some hope that returns. So that might be the end that gets pushed out. But then that means every other stage later out is pushed out.
Yeah.
It might be the IPO market opening is going to start dragging everything back up. There are a variety of different ways that this could change. And so I agree with you. I think the influx of money has caused a lot of what's happened. It's not clear to me how this will eventually shake out.
Yeah, it's not clear to me either. And some of it, I think, has to do with I think it's underrated how many companies will raise on a safe or a convertible note and then never make it to a priced equity seed round. Like, there's a lot of company failures at this stage. Actually, more companies fail at this stage than any other stage, just because there's more companies trying at this stage. So it's not like, I think there's this ideal path in people's heads, and most of the time it just doesn't work out. There's just not the market that they thought was there for the startup.
Right. Yeah. And investing at pre-seed is definitely a hard thing to do because
Yeah.
you don't have the data. There isn't like, oh, they have this much in sales. This is how much it costs them to acquire customers. You're
Totally.
definitely, it's a very, very early stage where you're betting on the idea, betting on the founders.
Yeah.
And so it's a hard thing. And you're right. A lot of them don't make it to the next stage.
So what do you think about so you can see in again, in this kind of the grid graphic here, say I'm a founder and I'm going out and raising $250,000 from close friends or people like that just to get this business off the ground. And then, my valuation cap is say 6 million. And then I need another 250, I need another 300 or so to get to the next set of milestones. So I raise it from a second set of investors and my valuation cap is maybe 8 million. And then I do it again at 10 million. And so I've got 3 separate set of investors on 3 different valuation caps on safes. People call this tranching sometimes. What's your opinion of tranching as a strategy?
So I think in terms of how I think about raising different, as long as they're separated by a larger duration of time. So like, let's say, you raise the 250 and then you spend, 6, 10, 12 months kind of working on your product, building out, getting more customers, and most importantly, de-risking your startup. So finding out these customers actually do want what you are trying to sell them or what you're trying to build, and they're willing to pay for it. You start de-risking, and that kind of shows, hey, I can raise at a higher valuation.
And what are the primary things that you want to de-risk? Like at the very, very early thing, like what are you as an investor looking for de-risked like items?
So usually when you start at a pre-seed, it's, oh, I have this amazing idea. I'm going to build this widget that solves this problem, and I know these customers will love it. And there are a variety of different things that you may have to tackle. I think the most important thing to tackle actually will be do customers really want it? You might think they want it. And when you start talking to them, you learn that, well, that's not exactly what they want. They want you to add this other feature to the widget, or they didn't care about your original widget, but there's a different widget that is actually much more important to them. And I think that's the primary thing and different startups have different how hard it is to build a product and other things like that. But if possible, that's the thing you most want to de-risk early on, is that do customers actually want this? Now, for some companies, you actually have to build a product before you can test out if they want that product you're selling. So it's not easy just to explain it to them. They need to actually try it out and use it. And then in that case, the thing you're trying to de-risk is, can you even build this in the first place? And, so for example, if you have an amazing vaccine that cures all diseases everyone's going to want that.
Right.
The question is, can you build it? And so it's the same thing, on the SaaS side. You have an AI that, you can build just general AI, and you can do that. I mean, people will want it.
Yeah.
There's no question of it. But most startups fall actually in the other camp of figuring out, do people actually want this? And more importantly, will they pay for it?
Yeah.
That's, I think, the thing that typically needs to be de-risked as early as possible. And
yeah. And so I love the idea of, knocking off, in addition to having like milestones that you want to hit, you want to knock off risks for investors. But you were mentioning that, getting back to the tranching idea within safes, it seems as though you were okay with tranching or moving up the valuation cap stack there, as long as there were enough time in between, or like the business had actually accomplished something to justify the next round of funding.
Yeah. So I see there's different ways people use it. So in the case where there's enough time between the rounds, where you've done some stuff, improved the company, you're just raising an extension, and we're seeing a lot of extensions right now. So in essence, you didn't quite hit enough to get to the seed level, or you're hearing that like the seed investors aren't that interested in you right now. Maybe you might kind of extend your pre-seed instead. And that's kind of where I see that sits in. And in that case, it's very important to understand how much of the company you've given away, what these all mean when it does convert. And Carta has an amazing tool for that. So make sure if you raise several rounds of safes, you understand, because these haven't converted yet. And so they don't show up on your cap table. So you don't realize how much of the company you've given away and how much is remaining for you and your co-founders or early employees. So that is definitely, as you raise multiple rounds of safes, keep that in mind, put the numbers in so that you at least understand in theory where you're going to end up when you raise the round, price round. But the other thing I've heard about tranching, which was more popular a year or two ago when the market was super hot, was kind of this idea of, let's say I actually want to raise $500,000. Instead of trying to raise all $500,000 in one valuation, I'm going to say, okay, at the first 250,000, I'm going to raise at, let's say, a 4 million valuation. And then once I get the 250,000, I'm going to raise the next $250,000 at a 6 million valuation. That may work for some people, but it's definitely gotten harder to do given the way the economy and the markets change, because now it's a question of like, all right, if you raised it 1 week at the 4 million, and then you're going to try to raise again at 6. Well, what happened between that week? What did you do? But for some, it's like, oh, well, I closed that initial amount and that's good enough. And then I'm going to raise the next set right away. That kind of tranching, it has happened, but I think it's gotten harder to do. Do you see a lot of that in your data as like kind of a raising 1 week at one valuation and then raise it like a week or a month later?
You see that on Twitter or X, nay Twitter. You see that occasionally pop up. I will say in our data, it's pretty rare that people will be raising at, a valuation cap of 8 million 1 week, and then the next week it's 12 million. And they're obviously in a week, there's probably very little material change to the business there. So it's definitely pretty rare. I will say we do see quite a few founders, like 35% or so of them, end up raising two safes at different valuation caps over the lifetime of their sort of pre-seed journey. So that is pretty common, but it definitely does not happen within a week. We're talking months or even years down the line.
Yeah, and for me, those seem like they're extensions. We see extensions happening at the later stage. And so I think with pre-seed, there is kind of an opportunity to do an extension, or some will even kind of raise a seed, just not a price seed on a safe. And so they kind of will say, all right, it's a high enough valuation and I'm going to consider this kind of our seed, but they just continue with the safe because of just how simple safes are to do. But do realize as you do this, you're stacking up all of these safes. You're giving up more and more of the company, and you're going to eventually have to have this conversation about what it means to convert all these safes into an actual price round.
100%. And so, as Mendel mentioned, Carta does have this cool free tool. It's at, if you just type into Google safes.carta.com, you can access this calculator. So you can add all your safes in here, and then you can add what you project to happen in your first price round. And then it will spit out, here's how much the safe note holders will own. Here's how much you will own as the founder. And you can kind of like scroll across this visualization and see, oh, that's how things change if I raise more money on safes. Just so you're not caught off guard, because one of the biggest things we see is that founders will come to their priced round and they will be kind of shocked at how little of their company they own. Or they'll be like, I thought me and my co-founder combined were going to own 55% of this company and we only own 45. That is tough. You don't want to be in a place where that sort of thing catches you off guard.
Yeah. And when you hit it at that point, there's nothing you can do. I think that's the more important part. You already took the money in from these investors. You already gave it to them. So it's happened. That's what you signed up for. So be aware as you're doing these additional saves, they don't show up on your cap table. You're not seeing the actual shares being kind of issued or anything like that. So the tool is an amazing way to just make sure you know.
For sure. I know we're coming up on the half hour mark here. Mendel, before we jump off, I did want to get any of your best tips or tricks for founders who are going out to fundraise now. It seems as though the VCs are back from European vacation time, and it's time to get back to work here. So any big tips for founders who are looking to fundraise in the fall?
Yeah, so the expectation is that this is going to be a very hot fall because startups are going to be raising again. Especially the ones that raised like 2 years ago, they should be hitting kind of the part of their runway where they need to raise again. So for founders going to raise now, first thing to realize is into the fall, the expectation is there's going to be a lot more other startups fundraising. And so just be aware that it can be a very busy time. The response rates from investors might be slower than you are expecting because there's just so much on the market. The other thing that you might be running up against is that a lot of investors, if they've previously invested in a startup, will be triaging and helping their existing startups raise this extension or this next round. So a lot of their time may be taking to kind of managing their previous investments and helping them out rather than finding net new investments. Awesome. So at the high level, be aware that that's happening. In terms of tips, I would say kind of 3 big things I think about. One is first, make sure you want to raise. This kind of goes back to the conversation we started with, which is, raising VCs. It's what you read about in the news. It's what you read on TechCrunch. It's all the exciting things, but it's not right for everyone. So first, make sure you as a startup and you as your co-founder have really kind of said, this is what we want to do. So that's tip number 1. Make sure that's what you want to do. Have that discussion. Tip number 2 is work on de-risking your business. Anything you can do, whether it's to sign a pilot customer, getting some initial revenue in, kind of just any proof points that say, hey, this is, we thought it was going to be this. And the reality is showing, hey, customer X really likes what we do. Some things would be like a logo or something where there's a known company that really loves what you thought you could sell them. So de-risk whatever you can, because I think that'll make your fundraising easier. And then I think the third tip is when you go out fundraising, particularly in the pre-seed, tap your network. So if you worked anywhere before, have any of your co-founders gone on and, maybe they had a good exit and, they'd be interested, friends and family you might know, reach out to other founders that may have raised recently and they may be able to introduce you to their investors. So definitely kind of work your network. And as you kind of discover, so people is great. First degree is great. You might get some second degrees, and that's really helpful. But lastly, if you're just kind of looking for other people, early stage VCs, make sure their thesis matches what you want. So in our case, for example, Required Wisdom Fund, we invest in seasoned professionals, so people with prior work experience. And so if you just graduated college, great. There's a lot of investors out there for you, but it's not the right fit for us. So don't waste your time applying to the investors where your thesis doesn't match.
Totally. I think that finding and categorizing the sort of general space of investors, especially for founders that haven't done this before, is a really big challenge and can be a hurdle. Carta is actually working on a couple of things and trying to maybe make that a little bit easier for you. But hopefully this was a great set of information. Mendel, I super appreciate you spending some time with me this morning. This was fun. We'll do it again, and good luck to all the founders out there who are starting their fundraise.
Great. Thank you so much for having me. It's a pleasure talking to you.
Absolutely. Absolutely. Good to see you.
All right. Goodbye.